Hey, welcome to another edition of You Down with MMT, the textbook MMT editions, or I should say series. I am doing all 33, I think, chapters as far as reading out loud, anyways, on my channel here. For more MMT related material, you can check out realprogressives.org. You can also check out Says Coup, where Jordan Sheridan does interviews along with our own Steve Grumbine. You can also check out Macro and Cheese on realprogressives.org. That usually, I believe it's but Saturday mornings, I believe they have different interviews with same people like Warren Mosler, who is one of the chief architects behind MMT. Steffi Kelton's had on. Oh goodness, Mike Hudson on there, Steve Keen, you name it, pretty much the who's who of either people who are adjacent to MMT or direct MMTers. But for today, I am reading from chapter 15 of the book you see in front of you, the aggregate expenditure model. In Chapter 4, we outlined the measurement of GDP via the expenditure approach of, or in the national accounts, or NIPA, underlying the fundamental premise in macroeconomics that it is total spending that drives output, or GDP, and employment in the economy. However, national accounts principles are founded on definitions which give rise to the two-end identity equating total spending to GDP and to NI, which is national income. In this chapter, we develop a model of output GDP determination, which will provide us with an understanding as to how the different components of expenditure interest interact and determine total output. This means we must outline the key variables which influence the components of total spending so that we can develop behavioral relationships. These components of expenditures are consumption, investment, government expenditure, and net exports. In Chapter 13, we introduced the concept of effective demand within the original aggregate supply demand framework, or D through Z, developed by Keynes in the General Theory of Employment, Interest, and Money, which was in 1936. Recall that Keynes defined the aggregate supply price of the output derived for a given amount of employment as the expectation of proceeds, which will just make it worth the while of the entrepreneur to give that employment, or to give that employment. We learn that this concept relates a volume of revenue received from the sale of goods and services to reach possible level of employment. At each point on the aggregate supply price curve, the revenue received would be sufficient to cover all production costs and desired profits at the relevant employment level. The important point here is that the relationship is expressed in terms of employment and the revenue expected to be received at each output level. We should be clear that Keynes was considering aggregate supply in terms of the expectation of proceeds, which is the money, income, or revenue that the firms expect to get from selling their output. First are thus considering to formulate plans to gain a volume of money or nominal profits. While GDP is a measure of output is fraught with problems, as we discussed in Chapter 4, The difficulty for what our current purposes is that GDP can rise simply because prices rise. What Keynes wanted was a consistent measure of economic activity. It is for that reason that Keynes used employment instead of output as his measure of aggregate activity. In this chapter, we thus have two tasks. First, we must express the model developed in chapter 13 in terms of output rather than employment. Second, we consider total expenditure and relate that to a simple model of aggregate supply. In chapter 16, next chapter, we will complete the picture by developing a more detailed aggregate supply framework. We can do that by using the national accounting concept of GDP at constant rather than current prices as our measure of economic activity. In this way, we do not diminish the importance of expectations in deriving production and supply decisions by firms, but we abstract from price changes and assume that firms react to changes in aggregate spending by adjusting only by quantity of output rather than both the price and the quantity. In other words, we adapt for the time being the assumption that firms respond dollar for dollar to increased demand by increasing output and income. We can justify this assumption of quantity adjustment in two ways. First, firms use markup price principles whereby they add a profit markup to their unit cost and face roughly constant unit cost over the output range within which they normally produce. Typically, they maintain some excess capacity and can thus increase output relatively easily without further investment in productive capacity, which would take time. If they face insufficient capacity relative to demand, firms are likely to raise prices to ration demand, which inevitably leads to the loss of customers to competition or competitors. There we go. Second, firms face various costs when adjusting prices and thus only periodically make such adjustments. It has been said that firms use catalog pricing, whereby they make their price known to their prospective customers through advertising and other means, and then are prepared to sell goods and services at those prices, irrespective of demand, up to their full productive capacity. At the end of the current catalog period, they will then make any necessary adjustments to prices based on expected future demand and any recent and expected movements in unit cost. I guess you can see next chapter for that. 15.2, a simple aggregate supply depiction. And 15.1 depicts simplified constant price aggregate supply relationship that we will work within this chapter to concentrate on the way the economy adjust in quantity terms only to changes to aggregate demand. The relationship is drawn as a 45 45-degree line emanating from the origin with total expected revenue on the vertical axis and output on the horizontal axis. The 45-degree line shows all points where the expected revenue is equal to output aggregate supply. We also measured planned expenditure to constant prices, inflation adjusted aggregate demand. I did see I was reading from the book, so there you go. Okay, so yeah, I'll put it to you this way: Figure 15.1 does show a uh, a L-shaped line, and a line in the middle of it goes straight up. So 45 would be the bottom portion of the line. In chapter 4, we explain the different perspectives that we can take in measuring economic activity. The expenditure, income, and output approaches provide different views of the national accounting framework, but they yield the same aggregate outcome. The total value of goods and services produced in any period is equal to the total spending and the total income generated, which basically are wages, profits, rent, and profit. Okay, it's profit twice there. In that same period, as we will see in chapter 16, when we consider aggregate supply in more detail. Firms supply a particular level of output and incur costs of production. As long as they can generate enough revenue to cover the cost and raise their desired profits. Note that the vertical axis shows the revenue that is expected to be generated by employing workers and producing output. In other words, it is forward-looking. However, oh wait, that was the end of the sentence. For some reason, I tend to do like run-on sentences, which is my thought process, I guess. Anyway, so however, by producing output, incomes will be generated, most of which will be spent. The 45-degree line shows us that the points where the revenues generated are equal to the expenditures, which, of course, must be true because spending must generate revenue. The expected revenue provides a measure of total revenue or expenditure, which also equals income. From the perspective of firms, it tells them the expected proceeds that can be generated by selling to different levels of output. The other point is point to note is that we have not represented full capacity output on the graph. When the economy is operating at full capacity, firms are unable to continue expanding output in response to additional spending. When we formally introduce the expenditure side of the economy in the next section, we will also define full employment output, beyond which firms cease to be quantity adjusters. 15.3, aggregate demand. In chapter 4, we learned that firms generate additional productive capacity through new investment in order to produce national goods and services to satisfy demand. Here, for simplicity, we are assuming no depreciation of the existing stock of productive capacity. Once the capital stock is in place, firms will respond to increases in spending for goods and services they supply by increasing output up to the productive limit of their capital and the available labor in other inputs. Or inputs, not inputs. Beyond full capacity, they can only increase prices when increased spending occurs. We assume that potential output is fixed for the period we are analyzing. By adopting the assumption that prices do not adjust to changes in demand, we thus say that higher aggregate demand will lead to increased production, which in turn increases national income. Note that as a result of our fixed price assumption, all extra expenditure increases both GDP and constant price or constant price GDP, GDP adjusted for inflation. With that said, I will be right back. Why is this not working? Hey, and welcome to the textbook MMT series. We are on chapter 16, the aggregate expenditure model, chapter 15, page 219, if you have the book. If you don't, buy the book and follow along if you like. Anyway, so let's see. The basic macroeconomic rule is that subject to the existing production capacity, total spending derives output and national income, which in turn drives employment. In Chapter 4, we learned that total expenditure in any period is expressed as the sum of the following sources of spending: consumption by household or persons, C; investment spending by firms, investment; government spending, or G. I'm sorry, the first one was I; export spending by foreigners, or X; minus import spending by domestic residents, or M, which we denote as net exporters, or combine NX, equals X minus M. The sum of these expenditures equals GDP as a matter of accounting. Total expenditure sums to total output and also total income. From the National Accounting Framework, we know that total expenditure, or E, in the domestic economy is any part in any particular period can be expressed as 15.1 E equals C plus I plus G plus X and minus M. You will see that while exports add to total spending in the domestic economy, imports lead to a drain in spending because they represent the spending of local residents, firms, and governments on goods and services produced by other nations. I want to reiterate that the C is for consumption by household or persons. I is investment is spending by firms. G is government spending, or deficit spending, if you will, and export spending by foreigners, or X, minus import spending by domestic residents, or M, which they denote as net exports, or NX, equals export and imports. There we go. Anyway, so back to what I was doing. You will see that while exports add to potential spending in the domestic income, imports lead to a drain in spending because, okay, I already read that one, I think. Yeah, that part I read. The equilibrium level in national income, or Y, is determined by the aggregate demand. 15.2, which is, I think it's aggregate demand, minus, was it exports, I think. I think it's exports. Yeah, export spending, yeah. Sometimes I go back to my own notes here on the page. Anyway, so you should note that the level of GDP that is produced by the current period's expenditures does not necessarily have to equal the full employment output level. Keynes, among others, demonstrated that full employment was not guaranteed by the market system. We considered those issues in detail in September chapters. There we go, chapters 5 and 12. When we studied the labor market. In the remainder of this chapter, we will develop a more detailed understanding of the behavioral of each of these components of total spending and explain how they interact to determine total output, or GDP, and national income, or GNI, I believe, or no, not GNP. Anyway, we will also derive an expression for equilibrium national income. In 15.4, which is private consumption expenditure, to gain an understanding of the determinants of aggregate demand, we have to focus on private sector decision making, which occurs within which occurs within a broad set of constraints resulting from the interactions between the government and non-government sectors. Private consumption spending is the largest component of total spending on GDP in most economies. Consumption is the sum of household spending on durable goods, for example, food, durable goods that provide benefits beyond a single year, for example, cars and white goods such as refrigerators, and services, for example, restaurants, theaters, and the like. And table 15.1 shows the ratio of private consumption expenditure to total GDP for most of the OECD nations. While there are notable exceptions, the outcomes in most nations are close to the OECD average of 60.8%. The ratios across countries are also relatively stable over time. What determines total private consumption expenditure? The most elementary theory of private consumption is RC is that it is a stable function of disposable national income, or Y_D. Disposable income is the flow of income that remains after taxes, or T, has been paid. Oh, that's the big corporations do all that tax subsidies. Anyway, have been paid. Let's see. On 220, table 15.1, assumption ratios are OECD nations 2010 and 2016%. Australia has 54.8, which was in 2010, and in 2016, 56.8. Austria, 51.5, in 2010, and 50.5, which so that in that case it's gone down. And the first one's gone up in regards to 2016, it is in comparison. Belgium, that's gone down too, 50.7 in 2010 and 50.0 in 2016. Canada, 55.6 in 2010 to 56.7 in 2016, so that's gone up. Czech Republic, 48.3 in 2010, 46.4 in 2016, and so on and so forth. Let's see. The more relevant, I would suspect, countries, you have the UK, which is at 62.3 in 2010 and 62.9 in 2016, and US 66.3 in 2010 and 66.9 in 2016. So a small uptick in these two countries. Anyway, we define disposable income as 53.3, and the box that is, Y_D equals Y minus T. A simple model of the government tax policy is that it levies a proportional tax rate, or small t, I'll just say, on total national income, which means that the total tax revenue at income Y is given as T equals small t capital Y. And that's in 15.4 as far as tables go, which will be coming up soon for visual effects for those who can see it. Assume that proportional tax rate, or small t, is 0.20 point. This means that every dollar of national income generated in the economy, the government takes 20% out in the form of taxation. The 80% that remains is disposable income if national income was equal to $1,000. Then the total tax receipt accruing the government would be equal to $200. We consider taxation to be a leakage from the expenditure system because it is income that is not available for private spending to be recycled back into the economy. Disposable income can be written as 15.5 Y and underscore D equals couple of Y minus couple of T equals couple of Y minus small t couple of Y equals 1 minus T, or lowercase t, there we go, and capital of Y. In our example, this would be written as capital Y underscore D equals I minus 0.2 and capital Y equals 0.8 capital Y. In economics, the aggregate consumption function is defined as the relationship between total consumption, or C, and total disposable income, which is Y. So 15.6 has capital C equals capital C underscore 0 plus small c, capital Y with the underscore D. Anyway, so C is is a constant and is base level of consumption, which is independent of disposable income and therefore called autonomous consumption. The coefficient C is called the marginal propensity to consume, or MPC, and measures the fraction of every additional dollar of disposable income that is consumed. The MPC is generally presumed to have a value between 0 and 1 if, for example, small c equals 0.75, then for every extra dollar of disposable income that the economy generates, consumption would rise by 75 cents. It is important to understand that the MPC in the model is an aggregate, which is an average of all the individual household consumption propensities. Low-income households tend to have MPC values close to 1, whereas the higher income households have much lower than average consumption propensities. This arises because lower income families find it harder to purchase enough goods and services to maintain basic survival. Higher income earners not only consume more in absolute terms, but also have more unspent income after they purchase all the basic essentials and luxury items. As we will learn later in this chapter, the distribution of income is an important consideration when seeking to understand changes in aggregate demand. For example, a change in tax policy that increases disposable income for low-income consumers would have a greater positive impact on final consumption than a tax cut aimed at giving higher income earners the same absolute increase in disposable income. For substituting the expression for disposable income in the equation 15.5 into consumption equation, which is 15.6, we can show the direct influence of the tax rate on private consumption. In 15.7, which is the table, they have capital C equals capital C underscore 0. Is it 0? Yeah, 0. Plus lowercase c capital D, capital Y and underscores D equals capital C underscore 0 plus smaller c, and then quotations investment or I minus T or lowercase c, and then capital Y. Figure 15.2 shows the consumption function to graphical terms. Note here and in the graphs to follow that the vertical axis is specified in terms of actual expenditure rather than expected expenditure or revenue from the perspective of firms. As in figure 15.1, for simplicity, we will assume that expected and actual revenue are equal. Although in the real world, that is not likely to be the case. Later, we will consider what happens when expectations are not met. The consumption function cuts the vertical axis as at C underscore 0 is greater than 0. The consumption function is then upward sloping because we have postulated that consumption rises within national income. In Chapter 7, Methods, Tools, and Techniques, we learned how to derive a slope graphically. The slope of a line is the ratio rise, or capital rise, over capital run. In this case, in this case is the change in consumption spending, or C, I'll just say that. And run is the change in national income, or Y, as shown in figure 15.2. In fact, C equals lowercase c investment minus lowercase c capital Y, and rise and run over run, which is basically the word rise, which is capital, and the word run is capital. equals a C and Y equals, this is what, yeah, this is one of those chapters that have the equations that I I I remember a lot of what the letters stand for, but anyway, yeah, this part is kind of interesting on my psyche as far as that part goes. Anyway, so let's see. Skipping all that, the slope of the consumption function is thus given by the coefficient, which is lowercase c, I minus t, lowercase t, which is lower than the MPC because a $1 rise in national income translates into less than $1 rise disposable income, given that the marginal tax rate or t or underscore t or small t is positive. Yes, well, all this said and done, I'll make sure they have all these different letters and all of this stuff running down and shown. Oh, whoops. There. Hold on. Okay, so on page 222, figure 15.2 does show a L-shaped line for a foundation and a wall. Then you have uptick in the line. It was like 45 degrees. Now it's slightly more than 45 degrees up. Anyway, yeah. Seriously, if you want to see what I'm trying to express to you, you have to buy the book. So anyway, I'm going to try not to do those things because there's no visual effect here. Anyway, so you should be able to work out what would happen if the MPC increased. The result would be an increase in slope of the consumption function such that is every level of disposable income, or at every level of disposable income, total consumption would be higher. What determines aggregate savings, or capital S, and it's actually question marks, I read that wrong. Anyway, saving at the macroeconomic level is residual that remains after households have made their spending decisions. Given the MPC disposable income takes the value of lowercase c, we can define a related concept, the marginal propensity to save, or MPS, or lowercase s, which for save, I believe, which is 1 minus the marginal propensity to consume, or S equals 1, 1 minus C. Note that since disposable income can only be consumed or saved, when national income rises, the government takes out some taxes, leaving an increase in disposable income, which is when the source of increased consumption via the marginal propensity to consume, with the remainder of the increase in disposable income being saved. If the MPC is 0.75 and the tax rate is 0.2, then if national income increased by 1,000, total tax revenue rises by 200. So disposable income rises by 800. Consumption then rises by 0.75 times 800 equals 600, and 200 is saved. 15.5, private investment. When macroeconomics use the term investment, they are referring to a very specific type of spending that does not accord with the common usage of the term. For example, a layperson might think of investment as a person putting money or some money in a fixed term deposit at a bank, or purchasing some shares in a company. National account meaning of investment is any spending that adds to the productive capacity of the economy. That is, adds to the capital stock. Capital is in this context is productive plant and equipment or other capacity which defines the potential output of an economy. Thus, when a firm builds a new factory or purchases a new piece of machinery or technology, whichever prefer as far as a particular part goes, it is considered to be investing. If you are having trouble distinguishing between the two, ask yourself this question. Does the investment require labor to produce it? Clearly, it takes labor to produce plant and equipment, while it does not require labor to produce a checkable deposit at the bank, aside from the significant amount of labor to make an entry on the bank's balance sheet. Generally, firms invest, but households consume and save. The one major exception is residual real estate investment, which is included as a investment. But here again, the economist definition differs somewhat from the layperson's because only newly constructed housing counts. Purchases of existing or used housing do not count as investment for the purpose of GDP accounting because it is not newly produced. Again, if you buy existing housing, there is no labor required at the time to produce it. Housing is counted as an investment not for the period in which it was built. Changes to the stock of inventories, which are unsold goods, are also considered to be a component of business investment in each period because they add to the potential of the economy to meet current aggregate demand for goods and services. As we will see, the dynamics of inventories provide important information about the state of business cycle. Table 15.2 presents a snapshot of the Australian national accounts showing the quarterly and annual growth of rates of the components. GDP up to the final quarter of 2017, which are based on the seasonal adjusted expenditure chain volume measures. The organization of the expenditure components is based on the standard national accounts framework that we discussed in Chapter 4, and which is broadly shared across the world. Under the heading gross fixed capital formation are listed a number of individual line entries which comprise the separate categories that the statisticians use to estimate total investment spending. The change in inventories is classified as a separate category. Economists distinguish between gross investment and net investment. Gross investment is the total spending by firms on new plant and equipment and inventories. However, in each period, the existing capital stock depreciates. For example, machines wear out and or become obsolete. Buildings require maintenance, and cars fleets require updating. Some of the gross investment in each period merely covers the depreciation of the existing capital stock. Okay, so in 15.2, there's a snapshot, as I think is explained above, of the percentage change September 2017 to December 2017, percentage change December 2016 to December 2017, percentages points contribution to growth in GDP September 2017 to December 2017. So obviously the same time period as far as that part goes, but yeah, it's the final consumption expenditure. That's the first title portion of it. General government 1.7 in the percentage change of 2017 to 2017. 4.9 in the percentage change in 2016 to 2017. And 0.3 in percentage points in contributions to growth in GDP September 2017 to December 2017. Households 1.0 in the first, 2.9 in the second, and 0.6 in the percentage points contributions to growth to GDP September 2017 to December 2017. September. I'm not sure if I said September or December, one of the two. Anyway, so let's see, in private. Yeah, anyway, I'm not going to get into that because, again, a lot of these are visual and I can take a lot of time to say it, but there's no real point, I don't say, at least I don't think. Again, you'd have to buy the book and be able to see the graphs I'm referring to. Anyway, so let's see, on to page 2024. Okay, so not net investment is the component of gross investments that adds new productive capacity, that is, increases the overall stocks or capital stock. Net investment is thus gross investment less total depreciation. In this chapter, we assume that there is no depreciation of existing capital stock and no planned changes in the stock of the inventories. In other words, for simplicity, we assume that gross and net investment are equal. We assume for now that the investment is a purely autonomous or exogenous source of spending in the economy, an injection of expenditure. Be right back, but be right back with 15.6 government spending. Stay tuned. Hey, welcome back. We are still in, see, I think page chapter 15, 15.6 government spending. We have already introduced one element of the government's interaction with the non-government sector, namely the proportional tax rate, or on a small t, which is our simplified expression for what is a complex tax structure in a real world economies. The national accounts framework, which shows that government spending takes a variety of forms. First, all levels of government purchase a range of goods and services from the non-government sector as a means of fulfilling the social and economic goals. Some of the purchases are for consumption goods and services, or yielding services over a fixed period, usually 12 months, such as outsourcing welfare services, while other spending is categorized as public investment or public capital formation, which yields services over many periods, such as a federally funded public transport system. The latter category of spending generates the valuable public infrastructure that enhances the welfare and profitability of the non-government sector. The second, government directly employ workers, such as public servants, who provide a range of services to the public. Third, the government provides a range of transfer payments to the non-government sector in the form of pension and welfare entitlements, and so on. In Chapter 4, we learned that the National Account Framework did not include transfers as a component of government spending because they do not constitute a final demand of goods and services by government. The final demand impact of the transfer payments is measured when the recipients, for example, households, spend. In our models, which are stylizations of the national account, measured the flow, or capital T, total taxes, represents the net taxes, which is total tax revenue minus total transfers in the non-government sector. Net government spending, that is, government spending minus taxes net of transfers, transfers, is determined by two broad forces. One, the discretionary decision that the government takes in setting its fiscal policy, that is, levels of expenditure and tax rates. Two, the state of overall economic cycle impacts on net taxes and hence new government spending. For example, when the economy is performing badly, net taxes will fall because of both lower taxes and higher welfare payments, even without explicit change in government policy. The opposite will be the case when the economy is growing strongly and unemployment is falling. We call these effects cyclical because they vary with the state of the economic cycle. They are also termed automatic stabilizers because they function automatically and act to stabilize total spending in both directions. We briefly discussed automatic stabilizers in Chapter 8 and 14. For the purpose of the following discussion, we will assume away from cyclical effects on government spending, or capital G, and assume that its level is exogenous to national income. We learned about the meaning of exogenous variables in Chapter 7, methods, tools, and techniques. Government spending is thus considered to be an injection of expenditure into the economy, in contrast to taxation, which is a leakage. So you see, it's spending before taxing. You always have to spend before you tax, either way, as far as a government period that controls its own currency, that is. And 15.7, net exports. Exports are goods and services produced in local economy, local economy, which are then sold to the rest of the world. While export spending boosts national income, we consider exports to be a cost in the sense that they deprive the domestic population of the use of the real resources that are absorbed in the production of the goods and services. Actually, I agree with that. Yes, and actually, Warren Mosler, or the founding fathers of MMT, actually has said that. So I didn't really understand it until just now as I read it. Imports comprise expenditure on goods and services which are produced by the rest of the world by households, firms, and governments. In other words, some of the consumption expenditure, investments expenditure, and government expenditure in each period does not increase domestic production and is thus considered to be lost. In kind of quotes, because it has leaked out of the domestic expenditure income loop. Imports are thus leakages of expenditure from the economy. Even though export expenditure is a leakage from the expenditure system, we consider it to provide benefits to the domestic economy by allowing households, firms, and governments to enjoy access to goods and services to the domestic economy by following households, firms, and governments who enjoy the access to goods. Oh, wait, all right about that. That are not otherwise available or are not available on a competitive quality and or price terms. The differences between exports or X and imports or M is called the net exports and X of a nation. A trade surplus occurs when exports are greater than imports. A trade deficit occurs when the opposite is the case. We will consider these issues in Chapter 24, when we will consider the determinants of net exports in detail by introducing the exchange rate and measures of international competitiveness. In this chapter, we simplify the model by assuming the exports or X are given in any year and determined by national income in the rest of the world, which is outside the influence of the domestic economy, but determines import spending. We assume that import spending, or M, rises with national income. Thus, the higher is the national income, the greater will be the flow of imported consumer goods and services and imports of capital equipment. For now, we assume that a nation imports a fixed proportion of every dollar of national income. That proportion is called marginal propensity to import, or small m, and has a meaning similar to the MPC. The marginal propensity to import is the extra import spending that occurs as a result of a dollar increase in national income, or a simplified import expenditure model is given as capital M equals small m capital Y. For example, if small m equals 0.2, then if national income Y rises by 1,000, import spending will increase by 200. The higher is the marginal propensity to import, the higher is the leakage in import spending at every level of national income. 15.8, total aggregate expenditure. Now that we have considered all the components of aggregate expenditure or demand, we can write the equation for aggregate demand, or E, as 15.10. Capital E equals capital C plus I plus G plus X minus M. As we saw at the beginning of this chapter, this is an accounting statement which is derived from the National Accounting Framework. We have developed some simple behavioral theories about the individual components of total expenditures. We assume that consumption and imports were positive functions of national income and that investment, exports, and government spending were determined in each period by factors invariant to national income. We also adopted a simple tax rule. We can expand the aggregate demand equation to reflect those behavioral assumptions, which in turn will allow us to derive an expression for equilibrium income. You can see that some components of total expenditure in the economy are dependent on national income levels, and some in I, G, and X are by assumption independent of autonomous to national income. We can use the techniques in Chapter 7, Methods, Tools, and Techniques to modify equations 15.11. We could usefully simplify the expression by adding together all the components of total expenditure that are autonomous, such as A equals C plus I plus G plus X, to write aggregate demand function as E equals capital A plus C 1 minus T equals M and capital Y. The slope of this function, the slope of the function will be steeper the higher is the marginal propensity to consume. And the lower are the tax rate and the marginal propensity to import. There's a section called "Try It Yourself," which which sounds kind of like "try it yourself if you don't believe me" sort of thing. Anyway. See if you can explain this result to yourself at this point. Think about a positive marginal propensity to consume as leading to an increase in induced consumption expenditure when national income rises. The tax rate and marginal propensity to import are leakages from the expenditure system for each dollar raise or rise in national income. We will provide a full analysis of this in the next section when we consider the expenditure multiplier. 15.3 shows the aggregate demand function and its individual autonomous components. The aggregate demand function is drawn with national output/income on the horizontal axis and aggregate demand or planned expenditure on the vertical axis. It shows the relationship between national income and planned expenditure, and two aspects are important. Total autonomous spending, A, is the intercept on the vertical axis, and the slope of the functional dependence on the marginal propensity to consume, which is small c, the marginal propensity to import, which is also small m, and the tax rate, which is small t. The aggregate demand planned expenditure schedule will shift if any of the components that make an autonomous spending change. Also, the slope of the schedule will change if any of the small c, t, or m change. If planned government spending or private investment were to rise, then the aggregate demand function would shift upwards, with the vertical intercept rising by the increase in planned spending. As a result, the planned spending would be higher at each income level. The opposite would be the case if the example of government spending was to be cut. In each case, the slope of the function would be unchanged. Figure 15.4 shows the impact of a rise in autonomous spending from A to A. The slope of the aggregate demand functions may also change. A rise in the marginal propensity to consume, C, and or a fall in the tax rate, or T, and or a fall in the marginal propensity to import, or M, will increase the slope of function, or the function, I mean. Figure point 15.5 shows the impact of a rise in the marginal propensity to consume. At every national income level, total planned spending is now higher. Another try it yourself. See if you can sketch the impacts and explain the meaning of a rise in the tax rate, a rise in the marginal propensity to import, and a fall in the marginal propensity to consume. You should also try to articulate what factors will influence the actual values of the marginal propensity to consume. A marginal propensity to import, or small m, in the real world. For example, poor nations with basic financial systems might be expected to have higher marginal propensity to consume than nations with higher disposable income. Okay, so now we're on 15.9, equilibrium national income. The term equilibrium in macroeconomics is used to refer to situations where there are no forces present which would alter the current level of spending, output, and national income. At that point, firms are selling all the output they produce based on their expectations of planned expenditure. Equilibrium is associated with the position of rest. You should be very careful not to confuse equilibrium with full employment. And macroeconomic equilibrium can also occur at times when there is very high involuntary unemployment. Full employment is only one possible point of equilibrium. Equilibrium occurs when planned expenditure is equal to national income and output. Now, under our current assumption that firms in the economy are quantity adjusters and prices are fixed in the short term, or in figure 15.1 showed us that the 45-degree line was the aggregate supply curve, since the level of aggregate supply equals national income. We are implicitly assuming that there are idle resources available for firms to deploy or in expanding output. At some point when the economy is operating at full capacity, firms are unable to continue expanding the quantity of output in response to additional spending. At that point, prices rise are inevitable. Okay. Equilibrium thus occurs when the aggregate demand function cuts the 45-degree line. Because of this point, the aggregate demand expectations formed by the firms which motivated their decision to supply are constant with the total planned expenditure of consumption, firms, government, and external economy. Figure 15.6 shows the equilibrium income and expenditure combination that defines the effective demand in the economy at this point in time. In figure 15.6, note also the two areas that lie between the aggregate demand function and the 45-degree line. Sum A is characterized by planned expenditure being greater than expected demand and hence actual output and income. Firms have supplied insufficient output and generated less national income than would be consistent with actual planned expenditure. In this situation, there is an unplanned reduction in the stock of inventories, which provides a signal to firms that they have been mistaken in their expectations. Firms will react to this unplanned rundown in inventories by increasing output and national income. On the other hand, zone B, is characterized by planned expenditure being less than expected demand and hence actual output and important income. Firms have been too optimistic and oversupplied output, generating more national income through their production output that would be consistent with actual planned expenditure. In this situation, an unplanned increase in the stock of inventories provides a signal to firms that they have been mistaken in their expectations. Firms would react to this increase in inventories by decreasing output and national income. The inventory cycle is an important part of the cyclical adjustment that quantity quantity adjusted firms make to bring their expectations and production decisions into line with planned expenditure, which brings the economy back into equilibrium. The decision to increase production means that more employment will be created and a higher national income leads to an increase in planned expenditure. Firms will continue to increase output, income, and employment until their expectations are matched by planned expenditure and there are no further unplanned reductions in inventory. Equilibrium is reached at the Y minus E combination, that is, where the aggregate demand function cuts the 45-degree aggregate supply line. Similarly, if firms find that they have produced too much so that there is undesired inventory, they will cut back employment and production. Firms will continue decreasing output, income, and employment until there are no further unplanned increases in inventory and the Y minus E combination is achieved. At that point, planned inventories are being held and firms are producing in line with the planned expenditure. Okay, so let's see, box 15.1, inventory movement and planned investment. We have learned that unplanned changes in the stock of inventories lead to GDP and national income adjustment because they signal to firms that their past expectations will with respect to current aggregate demand on which they based their current productive decisions were wrong. If the stock of inventory starts to increase beyond the normal level that firms maintain to meet the flux in spending, as it signals that the firms were overly optimistic about the level of aggregate demand. Once they form the view that the discrepancy is not a random event, they will cut back on production and national income will fall. Conversely, if inventories start to be depleted below the normal level and firms think this is not an ephemeral, episode, then GDP will rise because firms will revise their expectations of aggregate demand upwards. Output, employment, and national income will rise as a result. We have defined national income equilibriums as occurring when planned aggregate demand equals GDP or national income. In Chapter 4, we learned that in the national accounts, aggregate spending always equals GDP or national income, irrespective of whether there is a national income equilibrium. However, the accounting concept of total expenditure is slightly different to our macroeconomic concept of planned aggregate demand. The difference is that the flow of spending on inventories in any given period need not accord with the planned expenditure on inventories that firms chose to make to meet the normal fluctuations in their sales. The way the national accounts deal with this discrepancy is to classify all inventory expenditure in a period as part of a gross capital formation for our investment. In macroeconomics, we conceptualize the discrepancy by differentiating between planned, or lowercase p, and unplanned, or U, aggregates. So total investment equals I plus I's, where I and I are the IP and IU are the planned and unplanned investment, including buildings, including buildups or losses of inventories, respectively. It is the unplanned accumulation or decrease that is associated with changes in GDP and national income. Thus, one U can be positively or negative, so sales are lower or higher than expected. The stock of inventories rises, falls, and total investment will be higher or smaller than planned. So in the national accounts for a period, a non-zero level of 1 or I, would be included as part of the inventory investment. But from a macroeconomic theory perspective, we would consider a positive or negative value for I underscore U in any period as provided evidence that firms' expectations have been inaccurate and there is a dynamic process, in the economy whereby firms change output GDP and national income equilibriums. Thus implies that I and U equals zero. Be right back with that said. Hey, welcome back to the show. As a refresher, in case you're wondering what I'm doing here, I am reading from the book you see on your screen. If you're listening to this, I appreciate you listening. And I am reading from the macroeconomic book written by William or Bill Mitchell, L. Rondo Ray, Martin Watts. L. Rondo Ray has articles on the Levy Institute. You look that up. But William Mitchell has articles on, I think it's called a BilboEconomic.net. I could be wrong about the last portion, but I know it's Bilbo Economics. You look them up on Twitter as well. Martin Watts, still not sure, still not really sure who he is, but I'm pretty sure I'll learn about him very soon. Anyway, and also for more MMT material, you can go to growprogressives.org. You can also watch the Work Scholar at, I believe, 12 noon. At least I think is on Mondays. Oh no, Tuesdays. You can also watch the Luke Parcher Show. On all this is on Real Progressive in Action. Excuse me. Anyway, so let's see. We're on page 230. It's 1510. The exponential multiplier. There is an additional feature of the income of adjustment mechanism that is important to understand. The aggregate demand function, total plan or total planned expenditure in equation 15.13 is composed of two components. A, the autonomous spending component, which is A equals C, plus investment, plus government spending, plus expenditure, and B, the expenditure indicated by the level of the national income. C, lowercase c, which is consumption. I believe one is, I think it's like $1 or something like that. Minus taxes. I guess that's probably dollar minus taxes, minus imports. And I can't remember what the Y stands for. I think that's overall economy, aggregate demand. What would be the impact on GDP and national income if one of the components of autonomous spending changed? We know that GDP and national income will rise if planned spending rises and will fall if planned spending falls. The question of interest now is by how much will GDP and national income change after a change in planning spending that is driven by a change in autonomous spending. For example, an increase in government spending. Economists have developed the concept of expenditure multiplier to estimate how much national income, or Y, okay, so it's national income, will change for a given change in autonomous spending, or A. Figure 15.7 sketches the expenditure multiplier process from an initial equilibrium position. An increase in autonomous expenditure provides an instant boost to aggregate demand. Firms respond to in the increased planned expenditure and raise employment to produce the increased output GDP. As explained in the previous section, national income increases. This rise in national income induces further consumption spending, which leads to a further rise in aggregate demand. employment, and GDP. A proportion of the rise in national income leaks out in the form of higher tax payments and imports and increased saving. The process continues until the induced spending becomes so small that there are no further GDP increases. On the other hand, a fall in autonomous expenditure leads to leads to a series of cuts in employment, GDP, and tax payments, imports, and saving. And okay, so this is going to be pretty much mathematical treatment, the algebraic treatment. I'm not very good at these things, so I would try to read it, or I could just skip it, but I'll probably just read it just so I can put more context into it. The formal expression for the expenditure multiplier is derived directly from the equilibrium national income and expenditure relationship. The aggregate demand function was expressed as capital E equals capital A plus lowercase c, and 1 equals T minus M, and Y. The national income equilibrium condition is given as, in 15.14, Y equals E. If we substitute the equilibrium condition into aggregate demand function at 15.4, we get our 15.15a, Y equals E equals A plus C, 1 minus T minus M, and Y. And solving for Y by collecting Y terms on the left-hand side give 15.15b Y 1 minus C 1 minus T and plus M equals A. Thus, equilibrium income is 15.15c. Y equals A 1 minus C 1 minus T and plus M. The expenditure multiplier, A, is defined as the change in national income with the change in autonomous spending, or Y and A. And using differential calculus, you can see that it is equal to the coefficient of the A term in equation 15.15c. 15.16a equals Y slash A equals 1, then 1 minus C minus 1 minus T plus M. So if A changes, then Y changes by A times the change in A. So if A changes by $1, then Y changes by A equals 1 minus C 1 minus T plus M. The denominator of the expression for A is less than unity, so the multiplier exceeds 1. This is to be expected since after initial increase of autonomous expenditure, any induced increase in the consumption of domestically produced goods and services will lead to a greater increase in national income, or Y, that is, Y exceeds A. Oh, that is Y exceeds A. By inspecting the terms that define the expenditure multiplier, you can see that it is a ratio involving the marginal propensity to consume, the marginal tax rate, and the marginal propensity to import. Applying the tools you learned in Chapter 7, you can observe the following. Other things being equal, the higher is the marginal propensity to consume, the higher is the expenditure multiplier. Other things being equal, the lower is the tax rates, the higher is the expenditure multiplier. Other things being equal, the lower is the marginal propensity to import, the higher is the expenditure multiplier. The opposite is the case if the marginal propensity to consume is lower and the tax rate and marginal propensity to import are higher. The task now is to explain the economy process that lead to these conclusions. We start with the essential insight that aggregate demand derives output, which generates incomes via payments to the production inputs. Accordingly, what is spent generates output and income in that period. The income is then available for use. There are various ways in which the income derived from the payment arising from output production can be used, namely consumption, expenditure, saving, meeting tax obligations to government spending on imports. For example, workers who are hired by firms to produce goods and services spend part of their earned wage income on consumption. They also meet their tax obligations and may save a portion of their disposable income. A graphical treatment. A figure 15.4, we saw that if any of the components of autonomous aggregate expenditure change, the aggregate demand function shifts up or down with the extent of the shift, being measured for the change in the vertical intercept. Assume that government spending rises as a result of the government being concerned that the rate of unemployment is too high. In chapter 14, we learned that mass unemployment is always a result of deficient aggregate demand relative to the productive potential of the economy, and simply need remedies for government to increase total spending. Figure 15.8 shows the change in equilibrium expenditure and income when government spending increases aggregate. Okay, so aggregate A or aggregate G. Point A is the initial level of equilibrium national income and GDP. Y, which corresponds to aggregate expenditure of E. The aggregate demand function is given as capital E equals capital C plus 1 or plus I plus G plus NX. So that's net expenditure or some to that effect. I forget. I think net export. That's what it is. At this point, there are no unplanned inventory changes. The firm's production decisions are based upon expected aggregate demand being realized. Now, government spending increased by, government spending, which increased the aggregate demand function, where expenditure equals consumption plus investment plus government plus net export and national income increases to Y, which I think is import. I'm not sure about that anymore. Anyway, which corresponds to aggregate expenditure of E. The new equilibrium national income is at part B. I think Y is actually I've said it multiple times here, but it hasn't set in yet. I think Y is aggregate demand, I think. I want to say that's what it is. You guys can go back in the previous chapters I've read in the past week and a half or two, and it should be in there as far as like the actual definition of what the letter Y stands for in these equations. Anyway, so the reason that equilibrium, national income, and GDP increase relates to the firm's revision of expected expenditure when the government injects the new autonomous spending into the economy. Aggregate spending at the current equilibrium is greater than output. The difference is that line segments are AA in figure 15.8. I think it's the aggregate something. This distinct indicates that the excess aggregate demand relative to GDP and the stock of inventories would be falling. Firms would soon revise their expectations of aggregate demand upwards and starts to produce more output and generate higher levels of national income. And they would continue to increase production and national income under their aggregate demand expectations were consistent with the actual aggregate demand, a state which occurs at point B where the new aggregate demand function cuts the 45-degree aggregate supply in line. Note that the change in the equilibrium national income, or aggregate Y, is greater than the initial change in autonomous spending, or AG. The difference between the two changes is given by the line segment of CD. How do we explain this difference? The expenditure multiplier indicates by how much national income changes when there is a change in autonomous expenditure. The larger is the multiplier, the larger is the change in national income for a given change in autonomous expenditure. You can see from figure 50.8 that the total change in aggregate demand, or AE, following a change in autonomous expenditure. In this case, AG is the sum of AG segment BD and the induced consumption spending of segment DC. That follows the initial rise in national income, and this is the process illustrated in 50.7. The induced consumption spending is shown as induced domestic spending in figure 15.7 as firms react to the initial disequilibrium at point A in figure 15.8, the excess aggregate demand, or AA, and by increasing national income, households in turn increase their consumption expenditure, but at the same time, imports are rising by aggregate Y. Tax revenue is rising by T aggregate Y, and households save a portion of each extra dollar of disposable income, or I minus C aggregate Y. These leakages mean that each subsequent round of induced spending is smaller than the previous one and eventually becomes zero. At that point, the economy reaches the new equilibrium at point B and figure 15.8. So the total change to output and national income, or aggregate Y, is equal to the total change in aggregate expenditure, or AE, which is equal to the initial change in autonomous spending, AA, plus the induced consumption, or AC. Numerical example of the expenditure multiplier at work. In our example, there is initial spending increase of 100, which might have been a government order for a new public school building. Very cheap. This extra 100 in government spending leads the construction firm to produce more output and increase total income payments by 100, under the assumption in this chapter that firms are quantity adjusters. Some of that 100 is earned by construction workers in the form of wages. These workers and other income recipients then spend some of the additional income on goods and services produced locally in further field. Refer to the figure 15.7 to reinforce your understanding of the sequence of events. Assume that the marginal propensity to consume is 0.75. The current tax rate is 0.20, and the marginal propensity to import is 0.20. This means that for extra 100 of national income, this means that for an extra 100 of national income, $20 goes to tax revenue and drained from the domestic economy. Disposable income thus rises by $80 and household consumption rises by $60, with the residual being additional saving of $20. $20 is spent on additional imports and is lost to the domestic economy. Total leakages from the initial 100 of extra income that is generated, namely taxes 20, plus saving 20, plus imports 20, and thus 60, leaving additional consumption on domestic production, or produced goods and services at 40. The way to think of the second round expenditure injection in 15.7 is to note that national income rises by $40 in response to the additional consumption and spending domestically produced goods and services, which is referred to as induced consumption, and then to focus on the additional leakages. After taxation is taken out, the consumers determine how much they wish to spend on increased consumption. Table 15.3 shows the process for 9 rounds of additional induced domestic spending following the initial rise in government spending by 100. By the 10th round, the additional spending is too close to zero to tabulate. We deliberately use the term round so that as to not give the impression that the adjustment follows an orderly process across actual time. Rounds, the rounds are of indeterminate length and may be irregular with respect to each other. And each successive induced spending increases is smaller than the last focus of the leakages. Then the initial spending fans out or spreads throughout the entire economy. The initial spending, therefore, multiplies into much larger increase in spending. Note that the leakages are getting smaller with each spending period. In the bottom row of table 15.3, we see that some of all the period by period changes in GDP equals 166.6666. The total increase in tax revenue is 33.3. The total increase in disposable income is thus 133.3, which leads to the total induced consumption of 100 and the total increase in savings to 33.3. Total input or imports rise by 33.3. The total additional leakages from the expenditure system, taxes, savings, and imports sum to 100 at the end of the adjustment period, and this is the amount of the total initial injection in autonomous expenditure. At the point when the additional leakage equals to additional injections, the system is at rest, and the multiplied impact of the initial injection is autonomous expenditure is complete. Excuse me. Think back to our algebra definition of national income equilibrium in equation 15.15 and the related expression for the expenditure multiplier equation 15.16. If we substitute the assumed value in this example into the multiplier formula, we get multiplier aggregate y slash aggregate g equals 1/1 equals lowercase c 1 minus t plus m equals 1. Then you have 1 minus 0.75. Then you have 1 minus 0.20 plus 0.20 equals 1.666. Excuse me, all this reading. Anyway. Yeah, okay. Saw that. The multiplier is the total change in GDP for $1 initial increase in aggregate demand, which we have calculated to be 1.666. This means that this means that if autonomous expenditures, for example, government spending rose by 166. Oh wait. Rose by 100, the total change in GDP after the economy adjusts to the higher production and income levels would be 166.7 rounded, which matches the analysis in table 15.3. We have thus also derived a condition for macroeconomic equilibrium following a disturbance in one the exogenous expenditure components. The economy restores equilibrium when total leakage exactly equal total injections. Changes in the magnitude. Changes in the magnitude of the expenditure multiplier. Equation 15.16, define the expenditure multiplier as aggregate Y and aggregate G equals 1 minus C, 1 minus T plus M, which means that its size depends on the marginal propensity to consume, the tax, and the marginal propensity to import. The following conclusion can be drawn at this stage. The multiplier is larger or smaller. The larger, smaller is the marginal propensity to consume. The multiplier is larger or smaller. The smaller or larger is the marginal propensity to import. The more open the economy is to trade, the lower is the multiplier. The multiplier is larger, smaller. The smaller, larger is the tax rate. A higher marginal propensity to consume means that each successive round of induced consumption spending is larger, other things being equal. Given that the marginal propensity to save, or S, is just 1 equals C, the one or I, one of the two. It doesn't actually say. Just anyway, the multiplier is higher when the marginal propensity to save is lower. We'll say investment on that one. Actually, the last part was investment. In general, the lower are the leakages, taxes, savings, and imports from the expenditure system. The higher will be the multiplier. This is because the lower the leakage from each spending round, the larger is the induced consumption. Earlier in the chapter, we learned that the slope of the aggregate demand function, see figure 15.4, was C1 or I minus T, M or minus M, excuse me, which tells us that the change in aggregate spending for a given period in national income is larger than the is the marginal propensity to consume. Now, lower is the total rate, or I'm sorry, tax rate, or small t, and the marginal propensity to import, which is small m. Consider an increase in the marginal propensity to consume, which is small c. Figure 15.9 depicts this case. The initial aggregate demand function for MPC is associated with the national income equilibrium at point A, where expenditure generates production and national income of Y. When the marginal propensity to consume rises to MPC, the aggregate demand function pivots upward at the vertical intercept at the at the current equilibrium income level Y, households choose to spend an increased proportion of each dollar of disposable income on consumption. The initial change in aggregate demand, or E, is measured by distance A to A. Okay, so we have figure 15.9, which again, I won't be able to actually describe to you. The economy responds to the increased consumption spending by increasing production and national income. The higher multiplier as a result of the higher MPC then drives national income further, and the economy reaches a new equilibrium as point B. At this point of the economy comes to rest again. The following conclusion can be drawn on this stage. The slope of the aggregate demand function is steeper, shallower than the larger or smaller is the marginal propensity to consume. This means that for a given flow of autonomous spending, aggregate demand and national income will be higher if the marginal propensity to consume rises and vice versa. The slope of the aggregate demand function is steeper or shallow than smaller or larger is the marginal propensity to import, or M. This means that for a given flow of autonomous spending, aggregate demand and national income will be higher if the marginal propensity to import falls and vice versa. The slope of the aggregate demand function is steeper or shallower. The smaller the larger is the tax rate of T. This means that the given flow of autonomous spending, aggregate demand, and national income will be higher, the tax rate falls, and vice versa. The final point about the multiplier. We have described the multiplier as a process through which an increase of autonomous expenditure rises, induces consumption, and thus income through a series of steps to reach a higher level of expenditure and income. We have defined this as a point of equilibrium in the sense that once we reach this point, we are in a state of rest because no one has an incentive to change their spending further. We must be careful in our interpretation of the process. However, we must not conclude that spending and income are unequal while the multiplier process is unfolding. Recall from our discussion from the D and Z curve in chapter 13 that the intersection of the two curves at the point of effective demand. This point is in turn is consistent with the expectation of firms which are hiring the quantity of labor they think they need to produce the amount of output they expect to sell. Firms do not know know advance that their expectations will be met. Still, it is their expectations of sales that determine the point of effective demand and it is an equilibrium in the same sense. No one has an incentive to do anything differently. In the context of this chapter, 1 month's point of effective demand can be larger than the previous months. Let us say that firms have become more optimistic and so have increased their spending on plant and equipment. Rising investment. This chapter has taught us the higher investment spending will induce more consumption through the multiplier. This is because most employment in the investment sector producing more plant and equipment generates more wages and hence more consumption by workers. Over the course of this month, stores will experience higher than expected sales, which they could not have foreseen because their expectations for the month did not take into account for the new higher employment. The unexpected extra sale will run down their stock of goods on the shelves. We categorize this as decline of inventory, which is treated in the national income and production or product accounts as negative investment. At the aggregate level, our accounting will show that the reduce of inventory offsets at least to some extent the increased spending on plant and equipment. However, as stores draw down their inventories, they will place orders with producers of consumer goods to restock the shelves. This in turn will signal to the producers that they have seen that they need to increase production. At first, they can do this by increasing overtime work. However, as they come to expect the new higher sales to persist, they will hire more workers to meet the higher demand for consumption goods. You can see how the multiplier reprocess will work its way through the economy as a whole. In this particular case, it first increases production of plants and equipment, and then production of consumer goods to restock shelves, and then onto an entire array of consumer goods and services, which can then trigger more investment to increase capacity in terms of A through D curve analysis. The point of the effective demand continues to shift out to the right as firms raise their expectations of sales and hence increase employment. But at each point during the particular multiplier process, the employment decision is consistent with a point of effective demand that is equilibrium. Of course, that this process can work in reverse should investment decline. Through the multiplier process, firm will find their expectations disappointing. Stores experience falling sales and thus rising inventories and will cut back employment and output. But again, Each employment decision will be consistent with a point of effective demand. This is how changing expectations about the future affect the level of employment today. Conclusion. In this chapter, we provided a detailed examination of aggregate demand and aggregate supply. We have distinguished between the macroeconomic identities, those behind the national income and product accounts, and behavioral equations that allow us to say something about causation. We consider three important propositions about the macroeconomy. One, total spending drives total output, GDP, and employment in the economy. Two, there is no guarantee that equilibrium output will be associated with full employment. Three, a change in autonomous expenditures such as investment or government expenditures will lead to multiplied or larger change in GDP or national income. In Chapter 16, we will complete the picture by developing a more detailed aggregate supply framework. We can do that by using the national account concept of GDP at a constant rather than the current prices to our measure of economic activity. With that said, I'd like to thank you for listening for this whole chapter. I hope that you decide to subscribe to this channel if you have learned anything. Also, please share, comment, like, and hit that bell. Also share that you know what out of this, and also if you want to learn more about modern monetary theory, and not just from my channel, that you can go to Real Progressives in Action here on YouTube. You can also go to realprogressives.org, where there's lots of articles, books by authors, as you see up here. Elvira Ray has one coming out. I think it's how to make money work for us, or something to that effect. Either way, it's I think a pre-order on realprogressives.org. You can also listen to Macro and Cheese, where Steve Grumbine, our founder of the organization, that is, interviews pretty much a lot of people from different walks of life in regards to economics, industries, ideologies, stuff of that nature. Anyways, you look them up on there. They also have the same show, but on YouTube as well. I believe it's under the umbrella of Real Progressives in Action. Real Progressives in Action actually do have two channels. One is, well, if you look up Real Progressive in Action on YouTube, it'll come up with like at least two main pages. So there you go. Anyways, thanks for listening. I hope you decide to come back and listen to some more. Doing this so I can get the I guess you can say theory of modern monetary theory out. Yeah. Thanks for listening, and talk to you guys tomorrow. Peace out for now.